So now let's talk about asset location, which really is just if we simplify the term, is just all it is matching equity and bond portfolios with the tax optimal structure that minimizes the taxes due on these assets. So let's look at just a flow chart and quickly go over the benefits. And all asset location really is putting tax efficient equities into taxable accounts and bonds and tax inefficient equities into retirement accounts like your IRAs or 401k, etc. And you might say, well, what is the benefit of doing this? And the reason why you want to do this is because long-term equity gains, right, in taxable accounts, so tax-efficient equities, get beneficial tax-deferred treatment and lower capital gains treatment. So at the top rate for high net worth clients, that's 23.8% on a long-term capital gains, right? However, long-term equity gains in retirement accounts get significantly higher ordinary income tax rates. So in other words, if you take your equity, your long-term equity gains here in a taxable account and move it over to a retirement account, if you're investing in long-term equities and then you do a withdrawal, you're not going to get the low 23.8% tax bracket. You're going to get the 40.8% top federal bracket on federal ordinary income taxes. So that's why you really want to put tax efficient equities into taxable accounts, because you get the lower capital gains treatment. However, bonds and tax inefficient equities, you really want to focus on putting those in the retirement accounts because you get the benefit of tax deferral, for one. And those gains are already taxed at ordinary income rates. So if you were to invest in bonds and tax inefficient equities within taxable accounts, you'd essentially be getting taxed at short-term ordinary income anyways. So investing here, these bonds and tax inefficient equities in the taxable accounts, means you're getting ordinary income anyways. The benefit here of the retirement account is that you get to defer those taxes. And we'll talk about later why tax deferral is so important, is because these if you're a high net worth client, or you're advising a high net worth client and they're in a high tax bracket when they're working, if you're able to defer taxes on these tax inefficient assets like bonds or short-term capital gain equity strategies, what you can do is defer those taxes till they're in retirement, so you get the benefit of compound interest without the tax drag, and then you can withdraw that money at a lower tax rate. So retirement accounts have multiple benefits, right? Again, the tax deferral, the ability to minimize taxes. The other benefit that we should mention is that if assets are in the retirement accounts, you can charge your RIA fee pre-tax instead of after-tax, which again further reduces the tax liability for clients. And that's why retirement accounts, tax deferral can be so important for your high net worth clients who are in high tax brackets. So again, why you want to use asset location, because you want to minimize the taxes due on your client's portfolio, and especially in a low yield environment, minimizing taxes really means additional return for them without taking additional risk, simply by using the tax code to their benefit. So let's go over a math example. I like to try to keep these simple, just so everyone can follow, but let's go over why are after-tax fees a problem for low-yield taxable bonds. So again, let's just use some examples. The bond benchmark yield is at 2%. Again, in reality, it's much lower than this. The intermediate bond indices like the AG, are significantly lower than 2%, closer to 1%. Again, but we're using 2% just to simplify the example. Again, we're assuming we're managing a high net worth client. Their marginal tax rate is at 50%, so they're in a high or a state with high income tax as well. The RIA fee is 1%, just to make things simple. So let's again just quickly go through the math. Again, here we're assuming the RIA is charging their fee after tax, and here we're assuming the RIA is able to charge their fee pre-tax by moving their assets into a retirement account. So let's look at the math here. Gross yield is 2%. There's no pre-tax fee if you're charging it after tax, so that pre-tax fee is 0%. So the taxable yield is just your gross yield minus the pre-tax fee, so it's still 2% in this case. Now this 2% is a full taxable yield, so you have to pay taxes on that. Again, 50% of the 2% is 1%. So what they're left with, the client on an after-tax basis, before they pay the fee, is 1%, right? They've lost 50% to taxes. Now they're paying the RIA fee with after-tax money. So they're taking that 1% net return that they just got, they're subtracting the 1% RIA fee, and they're walking away with nothing, right? So they're investing at bonds at 2%, and the client is walking away with nothing because they're losing everything to taxes and the RIA fee. Well, what happens if the RIA is able to move these, tax inefficient assets into a retirement account and charge their fee pre-tax? Let's go through that example. So again, the gross yield is the same as it was before, 2%, but only difference is here you're able to charge your pre-tax fee. So that pre-tax fee of 1% reduces the taxable yield. So the taxable yield is no longer 2%. The taxable yield is 1%, significantly lower. And because the yield is lower, that means the taxes paid on the yield are lower. So the taxes here are 0.5% as opposed to the 1% when you charge your fee on an after-tax basis. So we've reduced the taxable yield, which means we've reduced the taxes. So the after-tax yield is 0.5%. And again, we've already paid the RIA fee, so there is no after-tax fee here. And so simply by moving tax inefficient assets to a retirement account where you can charge your fee pre-tax, you're improving clients' after-tax after fee return by essentially 50% of whatever you're charging. So simply by moving assets into a better structure, you're able to provide the clients with better yield. And this is a great way to kind of counter some of the low yield environment that we're in, or your clients are in rather, and help them better achieve their retirement goals simply through better tax planning. So now let's talk about, well, why is tax deferral of bond gains, why is tax deferral of bond gains so valuable in retirement, right? So here what we have is the age of the client as they're getting older, and then we have the presumed tax rate. Now the issue is when your client is working, they're in a high tax bracket, right? So let's assume they're a very well-to-do doctor or lawyer or entrepreneur, and they're working. They're in a high tax bracket. But if you've done optimal planning and used asset location, right, what happens is that when they retire, they're no longer getting that W-2 income. So their tax bracket, again, all their assets are either, again, long-term capital gains, which only get taxed when they realize it, or in retirement accounts where you can defer the taxes. So you're going to see a sharp drop-off with optimal planning in their tax rate in retirement. Obviously, as they start making withdrawals, that tax rate will go up, but there is a window to minimize taxes that otherwise would have been highly taxed if they would have withdrawn that while they were working. So by using optimal planning, what you can do is essentially defer taxes until they're in this financial planning window, again, before they start taking required minimum distributions and Social Security, which they can defer taxes and then take those gains out at a lower bracket. So you can defer bond gains during the high tax rate ordinary income working period to this kind of optimal tax window before RMDs and Social Security start. And you can kind of use this in combination with other strategies. So if the client has a second home in a no state income tax like Florida or Texas, they can kind of use this to further reduce their taxes. Again, this is why kind of a strong financial planning is important, because you can create different tax optimal solutions in a low yield environment, which again helps offset the risk that low yields propose. So kind of again, let's do a summary of putting bonds in taxable portfolio versus putting bonds in a retirement plan. So we'll talk about the issues with bonds in a retirement plan. So first, let's say, can you defer taxes, bonds in a taxable portfolio? No. We talked about how you can defer the gains on taxes on bonds in a retirement plan. So that's a benefit of retirement plans. Can you charge your AUM fee pre-tax? Not if the bonds are in a taxable portfolio, but you can if those bonds are in a retirement plan. Can you dump in a large amount of assets, right? Well, you can do that if it's in a taxable portfolio, right? You can dump in a large amount of after-tax money. But if they're in a retirement plan, you're limited by contributions to that plan in a given year. So you just can't do a large dump in, obviously, unless you're doing something like a backdoor Roth strategy. But you're typically limited in your contributions each year to retirement plans. So you have to figure out ways to back into it. And we'll talk about how some life insurance annuity solutions are essentially backdoor solutions where you can dump in a large amount of assets. So that's one issue with retirement plans. Can I invest in higher yielding long-term bonds without interest rate risk? So you can't do that with bonds in a taxable portfolio. You're still subject to interest rate risk, and in the retirement portfolio as well, you're also subject to interest rate risk. So the benefits of investing in bonds in a retirement plan are really in these top two here, is that you can defer taxes and you can charge the AUM fee pre-tax, thereby reducing taxable liabilities. However, as we talked about, investing in bonds in retirement plan doesn't solve the problem of low yield, high high interest rate risk problems or credit risk. And doesn't solve the problems that high net worth clients have contribution limits, right? So they're limited in kind of moving assets over into this retirement plan where they get tax prefer or tax advantaged benefits. So let's actually look at the contribution limits. Like, why can't high net worth clients just move all their taxable bond portfolio to retirement plan? Is because there are limits, right? Ideally, you would move taxable client bond portfolios to a retirement plan, and then you'd manage the tax inefficient equities in a taxable account. But again, they're often phased out of contributing to retirement limits, and these are just the some of the limits here. For the 401k, again, assuming there's a catch-up provision, they're over 50, it's about 26k. Traditional Roth IRA is about 7,000. Again, we're not including the backdoor strategies. And then if they're self-employed, this SEP IRA, solo 401k type plans are about 63,000. Obviously, if you're a high net worth client, you're nearing retirement, and you haven't done optimal tax planning to that point, you're going to want to move a lot more of your tax inefficient assets to your retirement plan, and you won't be able to because you're limited in your ability to contribute, right? So, again, high net worth clients are limited in their ability to contribute to these tax deferred plans, which could help them in the low yield environment. So we really need to focus on retirement strategies and financial plans that help them address this.